Hello, this is Quanry Invest. So Google is in a free fall right now. It is down around 3% from the opening, and at one point it was down around 5% from the opening itself. So why exactly is Google stock down today? So Google basically they just recently announced that they'll be acquiring another company called Wiz. So this company is a cloud security startup, and they're paying about a 64 price to sales for this company. The valuation is nuts. But anyways, so this company, for context, is growing at about 100% every single year. They've been doing that for the past 2 years already, and they currently have around 45% of the Fortune 500 companies paying for their services. So you just compare it to Palo Alto. Palo Alto has around 80%. This company over here is growing at 100% with 45% of the Fortune 500, and Palo Alto is growing at around 15 to 20% every single year. So for the growth, possibly, but I think this valuation is nuts. But let's see how it works out. So for Google over here, this Wiz company they basically provide cloud security to your Azure, your AWS as Google Cloud as well. So Google basically buying over this company is sort of like them trying to have a foothold in the cloud computing space. And this may be a bit risky because Google still has the antitrust laws over there. So let's take a look at this one over here.
Let's talk about what you think first about this deal with Google buying Wiz. It was something that they had gone after before. Wiz kind of stepped away and said that it was going to go for an IPO. A lot of questions about whether this can clear antitrust regulations in the Trump administration. What do you think?
That is the number one question, whether they can clear antitrust. And that's going to be the challenge. Because even the fact that Lina Khan is gone, the new head of the FTC doesn't seem like he's pro mergers, and we'll have to find out what's going on. But this is an important deal to Google because the future of the cloud is a secure cloud, and they've been pushing after this pretty hard, especially given what they have with the Mandiant deal that they had in the past. And of course, there's a lot to grow on the security side, much more than just Google Cloud. It's additive to the rest of the Google Cloud business. And so they need that as a way to compete with AWS and Azure in the space.
So if you're an investor and you look at this, you think, great, we want to see this happen, or do you look at it and say, it's hard to be the first one to foray into the new FTC and see what happens?
Someone's got to go first, and if there's going to be some muscle in the game, it's going to be Google. So I think it's actually a smart move for them to try to go after this, because there's nothing in this business that would say it's a monopoly or it's antitrust here, and it's a good test to see where the antitrust law is going to sit.
Okay, so like what this guy say over here, this could be Google trying to test the FTC, and basically they have that antitrust lawsuit that's going on right now. So if Google can somehow pass this deal, it could signal a more lenient antitrust, basically the antitrust FTC, and this could actually be a tailwind for Google if you don't want Google to break up. So for Google over here, it is currently trading at 20 times of earnings. I think this is just incredibly cheap for a company going at 15 times over the next few years. And so if you were to just look at some form of valuation over here. So this was the valuation that I did before Google's earnings. So assuming that Google services hold a P of around 22 times and the Google Cloud at around 30 times, basically Google's fair value right now is at around $190. And so you're getting way more Quantum XAI stake and all the different small bet stake for free right now. And it is currently trading at a very hefty discount from its fair value. So for me, Google is extremely simple. Google is a buy right now, and I bought it this morning as well. And so if you're to look at just a small valuation over here, assuming they grow EPS at around a 13% over the next few years, which it's definitely possible because they've grown their EPS for around 20-30% over the past few years already. So just assuming those estimates and assuming a 22 PE for this company has the Google Cloud Platform as well, which is growing at around 30% year on year. So I think 22 PE is more than reasonable for this company. It is giving you a 15% CAGR at this price. Bear in mind that these are conservative estimates, so 13% EPS growth definitely more than doable, especially if they continue reinvesting at this rate. Of course, the depreciation and amortization might be a problem next time, but the ROIC doesn't say so. So if you're to look at the ROIC over here, the return on invested capital is around 20%. And the return on capital employed is around 31%. So what it is trying to say is that CapEx is paying off for now, because if you can pump in a lot of money and still get a lot of returns from it, that's the prime spot, that's the best company that you want to buy. Basically, when you want to buy companies that reinvest, you want the best reinvestment rate, and then you want the best returns from it so that this company can continue growing on and on and on. That will yield you the best returns over the long run. Next, let's talk about some other companies that are down big today. So over here, you can see Tesla is down around 4% from all time, 4% just today. And in the past 2 trading days, I believe it's down around 10% already. So the problem with Tesla was, there was this YouTuber, his name is Mark Rober. So Mark Rober basically released a video mocking Tesla and basically talking about how good the other car business is, the other car being the LiDAR business. So over here, as you can see, this video is quite big already. It's around 13 million views. And yeah, yesterday, after he released this video, Tesla was down around 6%, and today is down another 4%. So I think for me, the problem with Tesla is just the incredible valuation. It's always traded on stories. And so I won't be going into this company anytime soon. Hopefully it goes all the way down to around $182 again. That would possibly be a buy, just for the fun of it, just to trust Elon Musk, I guess. But for me, principal stay, I would avoid this company. Next company is Meta. So Meta today is down around 4%, and from all-time highs, this stock is actually down around 21% already. So it is sort of like in a bear market already. So we had a 20-day winning streak where Meta just went up and up and up almost every single day, and now it's down all the way back down to around $580 already. So I think Meta currently is presenting a decent opportunity. It's currently trading at around a 24 times earnings. So if you have to look at just Meta's growth over the past few years, it's been incredible. I don't know how they still are able to sort of continue growing at this pace even when the entire world is basically using the app already. So over here, net income grew by about 59% last year. That's just incredible for a company that is already as big as Meta. So if you have to look at valuation over here, assuming a 22p for Meta as well, and assuming price now of around $577, and the EPS right now is 23.85, assuming a 15% EPS growth over the next 5 years, I do believe Meta can grow a lot faster than Google, because Meta is more geared towards small businesses, and the increase in small businesses will be much larger compared to large enterprises that spend money on Google ads. So if you have to look at just the valuation today, I think Meta is presenting a decent opportunity right now. It's around a 13% CAGR over the next few years. And if you have to just lower the EPS estimate, EPS growth estimate to around 13%, that is still around an 11% CAGR. So currently the stock price is pricing in around a 12% growth over the next few years. And if you do believe that Meta can continue growing at around a 15% for the next 5 years, which I think it can, as assuming it continues to monetize all the different platforms that they haven't monetized yet, for example your WhatsApp, your Reels, your Threads, and all that, and continue building up the AI infrastructure to increase the ad spend and increase the efficiency of the ads, then I think it is extremely possible for Meta to continue growing at 15% over the next few years. So I think for me, Meta is going to be a buy soon. Hopefully it drops a bit more so that I can get in on this company. Yeah, these are the 2 companies that I think are selling off big today. And yeah, and there's one last company. It's another Mag 7 company. It's quite boring, but it's Amazon over here. So Amazon is down big as well. It's down around it's down 16% in the past month, 12% year to date, and it's currently trading at a 34 times earnings. I think in terms of business quality, if you have to talk about the Mag 7 companies as a whole, I think Microsoft and Amazon are up there as the greatest business model as well as Apple. So I think Amazon is presenting a decent buying opportunity right now. If you want a predictable business that can continue to survive any recession, continue to grow, continue just continue on and on and on till maybe 20 years later, I think Amazon is a good company for you to buy in right now. Of course, it's not incredibly cheap at 35 times earnings, but for its growth, assuming that it can grow 20% EPS growth over the next few years, I think it is presenting a good buying opportunity.